Sanjay Datta, MD and Head Capital Markets Group at JM Financial, joins in on the show. Sanjay, hi, morning. The markets rebounded from the lows yesterday, post comments coming in from Ranga Rajan saying that core inflation is receding, making a case stronger for a rate cut by the RBI. How did you read into his comments? And does it seem like it is going to be an inevitable move by the RBI, a rate cut this time around on the 19th?
Good morning. Well, Governor Subbarao has been consistent in his comments of actually saying that the country needs to rein in both inflation as well as fiscal deficit. Having said that, the comments which he made yesterday in support of the Finance Minister's budget are frankly comforting. Our expectation is that they will continue, that is, the RBI will continue on gradual reduction in interest rates. It'll be phased out. We don't expect to see any sudden drops. What will happen on next Tuesday is anybody's guess, but the market is pricing in a 25 basis points cut anyhow. My personal feeling is that we should not be disappointed if it does not happen, and if it happens, that'll be good.
So how is it that you're telling your clients to approach the market right now in times of so much volatility, uncertainty in terms of the macro picture, and global markets holding up absolutely fine?
Yes, well, the fact is that the global cues are all positive. If you look at the US market, the Dow is trending higher with each session on the back of buoyant retail sales numbers as well as home sales. Japan has come off its all-time lows, albeit of a low base, but it's still up 30 to 40% this year. The European debt crisis seems to be under control, and Chancellor Merkel actually said yesterday that she would be now looking to speed up employment opportunities in countries such as Greece and Spain, where you have in excess of 50% of the youth unemployed, which is a change from the cry for austerity that she's been speaking of for quite some time. So whilst the global markets are positive, I think in India we are lagging behind. Not only that, we have seen extreme volatile movements, and it is due to a combination of factors. One is that we have actually recently come out of a period of no action into definitive action, and this has been followed up by the Finance Minister with regular inputs as to the process by which he plans to get the economy moving. The second is that we hope that we will actually see the positive side of industry kicking in, though the results last quarter have been slightly muted and negative, with certain sectors such as the fast-moving consumer goods as well as pharma now showing signs of margin pressure and compression.
Sanjay,
so all in all, my view is muted at the moment, and I'm telling my clients to be cautious.
So if your view is muted, do you expect Indian markets for next 6 months they are unlikely to do anything? Are we stuck in a range in the near foreseeable future?
Well, the Indian markets actually will ride on the back of EPS growth, and our expectation is that EPS growth over the next 2 years should be anywhere between 12 to 13% compounded. Given that, our view is that by end of December, end of the calendar year this year, we should see the Nifty at between 6,650 and 6,700, which is about an upside of 10 to 11%, and the Sensex would follow a similar trend. That's the view we see. There will continue to be periods of volatility. What we've seen is the moment there are announcements which are favorable, the market reacts extremely sharply and favorably. In February, we did not see too much of positive announcements. The budget was positive, but it wasn't dramatic in the sense of to stir the market into a frenzy, and that's why we've seen the kind of slightly downward trend and again, volatility over the last 2 weeks. I expect that to continue, but having said that, in April, I expect after the budget session the government to actually kick in with some passage of bills, etc. in Parliament, and that should give the markets a further fillip going ahead. Then again, towards the end of the year, the October quarter, I guess the uncertainty regarding the elections will again crop up. So all in all, you will see volatility. I don't see more than a 10 to 12% upside.
Sanjay, you did talk about growth and as to how that is going to instill, some liquidity or rather, some impetus into the market, and that's going to make the markets move forward. So let's talk about a few of the sticky points. How is it that you're approaching autos right now, considering the demand has been at a decade low? And do you think the pain is going to persist for the next few quarters as well?
Well, the answer is, it's not an easy answer because currently, yes, the outlook is extremely gloomy and grim. Having said that, if we do see rate cuts coming in and interest rates on auto loans, etc., coming off, you will again see a fillip in and pick up in the auto sector. But yes, to answer your question, I do see hard times continuing for the next 6 months at least for the sector, if not slightly longer, because we do see build-up of inventory, and frankly, we don't have visibility into when the rates will become low enough for customers to start buying again in the numbers that you need to see them buying to actually get the growth back into the system. Also, commercial vehicles is slowing down right now, so that is again another concern, and that will be again driven, I suspect, to some extent by infrastructure creation as well as crude prices. We have diesel prices going up every month now, and that's bound to have some impact, negative of course, on sales. You will try and find truck operators actually sweating their vehicles more rather than investing in new vehicles right now. I think the ability to pass on cost increases is also limited. So yes, all in all, I do see some stress in that sector.
What about real estate? Despite a choppy market ride, there are stocks like DLF which have been making all-time highs. Do you like anything out of that space?
I wouldn't like to comment on specific stocks, but having said that, the real estate sector has been beaten down quite a bit in the past 12 to 15 months. I'm sure you'll agree with me. So we expect that the sector will stabilize. There is pain, but I think the companies are gearing up for a period of lower growth, so they're not building out as aggressively as they would have in the past. They're trying to control inventory and not investing in land banks as they have in the past. So given that, I think you will see some prudence coming in, and that is being reflected in the stock prices. The hope is that there will be higher offtake of units across the country due to a variety of measures which the real estate sector participants are highlighting, the 20% pay now, 80% pay on possession schemes, etc. Again, these are highly sensitive interest rates, and if that environment is conducive, which the investing public expects, we should see further positive buoyancy in these stocks. But again, I would be cautious because we haven't yet seen any long-term trend or even medium-term trend for that matter in this sector.
What is your take on industrials? Do you think it's time to now load up industrials because the capex cycle eventually will revive, and typically when the capex cycle will revive, industrials as a group, they are the first ones which will be off the block?
I totally agree. Industrials is an extremely important constituent of the economy, but having said that, the industrial will frankly come into sectors which have been seeing a lot of pain due to a variety of reasons, be it supply in terms of coal and gas, or in terms of offtake agreements, as we've seen in some of the power purchase agreements, or in terms of roads. We are not going to see investment coming into that sector till such time these blockages are cleared. I do expect that these will happen, but frankly, my expectation is it will be over the medium term rather than the immediate term. By that I mean towards the end of the year, calendar year, rather than over summer. I do not see that movement coming through, frankly. It's unfortunate, but yes, we will have to wait a bit longer. But clearly, investment is required in infrastructure-related sectors. We can't keep on importing our turbines and other goods. It's going to unnecessarily put in pressure on the exchange rate, not to mention the fact that our own capacity gets diminished. But this will take time, and I think the finance minister is certainly aiming to kickstart the sector, but it will take time.